Oi, pessoal, bom dia. Obrigada pela presença de vocês na nossa segunda Global Managers Conference. Hoje a gente vai falar sobre tendências globais pós-Covid-19. Hoje a gente vai ter a presença da Lídia Halter, Senior Portfolio Manager da PicT, que desde 2016 atua como gestora de investimentos no time de ações temáticas com foco em estratégias de saúde e biotecnologia. A PicT é uma gestora suíça, independente, que tem mais de 183 bilhões de dólares sob gestão, entre os mais diversos ativos. Eles fornecem serviços para alguns dos maiores fundos de pensão, instituições financeiras, fundos soberanos e intermediários. A PicT é pioneira em investimento temático e, em parceria de exclusividade com o BTG, oferece ao investidor brasileiro a oportunidade de investir em megatendências sociais, ambientais, demográficas e tecnológicas, que estão remodelando o nosso mundo, através do fundo Global Megatrends Selection, que já está disponível na nossa plataforma do BTG Digital. Junto com a Lídia, teremos a presença do Richard Claude, Senior Portfolio Manager da Janus Henderson, que atua no time de Global Technology. A Janus Henderson surgiu a partir da fusão da Janus Capital Group e do Henderson Global Investors, e hoje possuem 300 bilhões de dólares sob gestão. Com mais de 350 profissionais de investimento, eles oferecem estratégias inovadoras, abrangendo renda fixa, renda variável, multimercado e alternativos mundialmente. Parceria de exclusividade com o BTG, a Janus Henderson vai oferecer ao investidor brasileiro a oportunidade de investir em fatores de longo prazo, que capturam disrupções tecnológicas, com foco em empresas de alta qualidade, com o fundo Janus Henderson Global Technology, que estará disponível na plataforma do BTG Digital. E mediando essa live, teremos a Laura Gonzalez, que é Head de Wealth Management da All Funds. E agora eu vou deixar vocês com o vídeo das gestoras.
Technology is an exciting sector. There are always new technologies and exciting areas of secular rapid growth. We tend to underestimate the size of new markets, but we also tend to underestimate the growing pains of a new technology, and we tend to overestimate the ability of companies to make sustainable profits. Investors are also prone to overpay for unrealistic profit expectations. So the ability to pick the right point in the technology adoption curve, to pick the right companies, and also to invest at the right valuation are key to generating consistent returns. And we do that with the experience on the team of having seen a lot of new technologies come to market by what we call navigating the hype cycle. The experience and depth of the team, I think, are key differentiators. You need that experience to help you identify the new technologies and then also pick the right point to invest in them. And we also have a valuation discipline and a very strong risk framework, which is not something you normally associate with a technology strategy. We also try and incorporate ESG, or environmental and social and governance criteria, not only to help us identify good companies, but also as an additional risk overlay. And we've also proven that we can scale this strategy, and we think that's important to grow with our clients.
Bom dia, muito obrigada, Laura, pela introdução, muitíssimo obrigada ao BTG Pactual pela oportunidade de nós fazermos parte desse evento de primeira linha, mais um ano de patrocínio da parte do Funds e mais um ano de gestores top entrando no mercado brasileiro. Good morning, Lydia. Good morning, Richard. How are you?
Good morning.
Good morning. Good, thank you.
Awesome. I take a special pride in sharing this panel with you both. I think we are going to touch base on very relevant topics today, such as biotech, health, and technology. We will start with technology, if you agree, as there is probably nothing which is more at the forefront these days than technology. We are going through a massive technological disruption that is impacting any given sector and corner of our society. So if you agree, I would like to address my first question to Richard, and it would be about technology, but also about the store market. Richard, what do you think about current valuations? Do you think that they are so high that could lead us to a new bubble like the one we saw back in the year 2000? Is that something that bothers you at all?
Well, thank you, Laura, and thanks for the opportunity for being here today. And thank you to BTG Pactual. I think you're absolutely right to mention valuation. I think it's so important when investing in the stock market generally, but particularly in technology. And probably, at any point in terms of when valuation has been important today is even more important. Now, I think if you take a step back and look at the valuation premium of technology to the rest of the market, actually it's not that bad. It's only 25% premium or so, mainly because the earnings of the tech sector has kind of held up better than the rest of the market. But then when you dive sort of further down beneath the aggregate, you see some very big differences and a huge bifurcation. Now, I'm sure many of you have seen that the top 5 stocks in the S&P 500, which are all technology stocks, they're now over 20% of the entire S&P 500, which is greater than the concentration we saw in 2000. Now, I think the big difference versus 2000 is they're a much larger portion of the earnings of the S&P 500. They're growing much faster than the rest of the S&P 500, about 3 times as fast. And their absolute and relative valuation to the rest of the S&P 500 is a lot lower than it was in 2000. So generally, I feel a lot more comfortable with the valuations for those technology stocks, given the growth prospects and the disruption that you mentioned. Now, the other end of the spectrum, I think there is some concerns around particularly some pockets of technology. There always have been these pockets of technology that get sort of overexcited and over exuberant. And it's there where we're seeing companies that don't make any money, that are burning cash flow, trading on 20, 30, 40 times sales, where we get a lot less comfortable. And I think we've always got to remind investors, you're investing in a stock, not technology. So while the technology is incredibly exciting, this company could have the best technology in the world, that doesn't necessarily make it a good stock, and you've always got to have a reasonable valuation behind it to justify a stock's performance longer term.
Thank you very much, Richard. And what about the society itself, right? Because we hear a lot of noise around valuations, but the society of today has nothing to do with the society back in the year 2000, right? If you think for a second, and that comes to my mind, Apple advertisement on iPod back in the year 2001, it used to say 1,000 songs in your pocket, right? And the iWatch advertisement these days says 60 million songs on your wrist, right? So this perfectly captures how different our society is. Don't you think so?
Exactly, and that's why I always come back to the key drivers of technology taking share of disruption are Moore's law and demographics. The fact that technology makes cheaper, better products every year. There just aren't many sectors that do that, and younger people and there's generations coming through, X, Y, Z, millennials, and they're just more willing to do things in a different way, which often involves technology.
You were talking, Richard, about the top 5 companies. If you take a look at the top 5 companies by market cap over the last decades, the conclusion you might get is that the winners of today might not be the winners of tomorrow, right? How do you handle this agile environment when it comes to make the right investment decisions yourself?
It's such an important debate. I mean, if you go back to IBM dominating mainframe computing, but then when we moved to personal computers, it was Hewlett Packard and Dell. And then when we went to smartphones, it wasn't those guys, it was Samsung and Apple and some of the Chinese brands that came through. And now we're sitting in today, as you say, with these kind of trillion and a half market cap companies that dominate this sort of mobile internet world. And we're saying, are they going to be the future winners in AI? Now, I think a couple of things are different this time. If you think about kind of what you need to be successful in the world of AI, you need a lot of money. which obviously all these companies have, and you need a huge amount of data. And again, these big sort of consumer internet platforms have a lot of that data. So they're in a wonderful place to dominate the new technology wave of artificial intelligence, which is going to be the kind of predominant technology for the next few decades. And then you have people like Jeff Bezos that are really trained investors to be willing to sort of take the investment it takes to kind of dominate these new technologies. That they had an e-commerce business, and then they sort of disciplined investors to think that I'm going to invest in a cloud business, and then you've seen the returns that's developed, and you see that within, say, Mercado Libre in Latam going into fintech, or Alibaba in China, building huge new sort of franchises in these huge new addressable markets to sustain growth for a lot longer than sort of a traditional sort of market would sustain. And I think that's what, again, gives some more legs to the growth of some of these companies, that they're now addressing massive new markets where they can be winners. Now, not all of them are going to be successful. And I think that's where we as active managers, really add some value, that, these indices are very backward looking, and you look at sort of the top 5 over any sort of given decade, and they very rarely are the top 5 in 10 years time. And I think that's what we spend, our time doing, is trying to sort of see who's going to fall by the wayside. You see Intel today, they had their market cap surpassed by Nvidia recently, and they've just, really given up the ghost on Moore's law for the first time in their history. And I think you can see those kind of changing of the guards happen across, not just within technology, but within the wider market as well. And we want to be on the right side of those.
Absolutely. So let's wait and see whether history repeats itself then. Lydia, we are talking about dynamism and things that are changing rapidly. Both biotech and health seem to have gained momentum when it comes to M&A and corporate acquisitions, right? We have seen decent inorganic growth within the sectors that you master. Do you think that this trend will remain in place and there's still room for M&A in both sectors?
Yeah, definitely. So, I mean, you've seen quite a run actually since 2011, and the last couple of years actually have slowed down a little bit. The main driver in the beginning was the appetite from pharma, because they were facing these huge patent cliffs. So drugs that were losing their patents, they had to basically fill up these holes with new drugs that they bought from biotech companies and to fill their pipelines. And now you see kind of a similar situation with large biotech. So they're facing now also competition from biosimilars. They're at the end of the life cycles, and they have a huge amount of cash to invest. And so the rhetoric has been very strong that they are looking for assets to acquire. What has changed, though, is that a lot of the smaller biotechs, they're quite well funded, since we had the strong run in the past, and there's just been a wide open funding window. So they are a bit more demanding when it comes to the price. So the bid-ask spread has opened up a bit, and that slowed down M&A. Nevertheless, I think we saw a couple of mega deals being done in the last couple of years, and I think there is potential for more deals coming forward.
Right, so the party will go on. And what about evaluation ratios that are being paid? What do you think about that?
I think that acquirers have become a bit more selective in what they look for. They look for really companies that have this scarcity value, so that they are in a niche, they have really differentiated products and don't have this competitive threat. Or on the other side, they go for companies that maybe have suffered on the stock market. Maybe they had a launch that didn't perform so well, and they were grabbing these companies at a lower valuation. So in general, I think the discipline has been there from acquirer's side. And I think there will be deal making going forward, but I think a lot of the biotechs actually want to go the way alone now.
Okay. I'm curious about your Global Megatrends flagship, Lydia, because I know you have an exclusive agreement with BTG Pactual to distribute it in the Brazilian market. To the best of my knowledge, both sectors, health and biotech, are present in the flagship. How could you easily explain to us the key differences between these two sectors, if I may?
Yeah, I mean, we don't like to talk about sectors because we really have a thematic view on the universe, so to say. And I think biotech, the biotech product is the closest that you could get to a sector. So you have the classical drug makers that we invest in, but we also have some adjacent segments such as tools, so science tools, research tools, etc. in there as well. For health, that's actually a broader strategy because if you think about healthcare, what that focuses on is actually only on sick people. So it's basically getting sick people healthy again. We think going forward it's so important to go more in a preventive setting as well, because the costs of healthcare are just expanding as people age, as lifestyles change, people get less healthy. So I think there is a strong trend that is partially driven by consumers themselves, partially also from insurances pushing people to lead healthier lives, to go to this more healthy living segment. So we have roughly 60% healthcare in the health fund, and the rest is basically stocks that are related to healthy living. This could be active lifestyle, this could be hygiene, just anything that makes a consumer live a healthy life for longer. So that's the main difference. The overlap is actually quite small. It's roughly 5% between the two strategies. So they're really not the same.
Very clear, Lydia. Thank you very much, even for neophytes like me. So that was an awesome explanation. I doubt we can move forward in the panel without visiting COVID-19, right? COVID-19 has been a tsunami in our lives, and it's unluckily a trending topic these days. And I would like to combine COVID-19 and technology for a second, addressing a question to Richard. Richard, to which extent do you think that the technological disruption that the pandemic has brought to our tables, our lives, our homes, has contributed to excessive valuations? Because we have been seeing many things blossoming, such as online foodies, digital content, virtual education. To which extent the pandemic has made an impact in this regard?
Yeah, I always take a step back and sort of say to clients, the reason why technology stocks are outperforming and the sector's outperformed is because technology is taking share of the global economy. And so the earnings growth of the technology sector is a lot faster than the rest of the market. Now, I think in contrast to many funds that will be presented to clients, or asset allocations and different asset classes, when I show you a chart of technology taking share and faster earnings growth, clients can all sit there and go, well, I contributed to that. I helped create that chart. I'm using more e-commerce and more online entertainment and all these things, ride hailing, food delivery. Now, I think obviously everything that's happened during this tragic pandemic has just accelerated. I think that's the key word. A lot of these trends, both kind of fairly mainstream existing trends like e-commerce, payment digitization, online entertainment. That's why Netflix has added 26 million new subscribers in 6 months. That's why we've seen the huge demand for e-commerce. Whether that be Mercado Libre in Latin America and Amazon in a lot of the world, or Alibaba in China. And then also there's some new areas that we've seen kind of probably not just accelerate, but get critical mass, probably pull forward those adoption curves by 3, 4, maybe 5 years. So you think about remote working. It was a thing, but no one really did it. And now there are 300 million daily participants on Zoom. Remote learning, again, you mentioned, again, a thing that people did when they lived in the middle of nowhere, but now, it's a thing. And, Harvard's going to be remote learning for the whole of the next academic year. Things like Fortnite, which were, kind of a game that was sort of becoming a platform for sort of social engagement virtually. You had a Travis Scott concert the other day that virtually, obviously, had 12 million live participants and another 27 million in the next 5 years. So, we are seeing this huge acceleration in a lot of these technology trends. And I think all of us can sit here today and say, well, how could we, it's been incredibly painful and tragic what's happened in the pandemic, these lockdowns, but how more painful would it have been to our working lives, to our family lives, if we hadn't had the technology tools that we have today? I mean, it would be almost impossible. You imagine doing this back in 2000 with a Nokia feature phone and dial-up internet. I mean, good luck with that. And I think that's why you're seeing a changing of the guard in the stock market. Recently we've seen Toyota's market cap be surpassed by Tesla, Netflix surpass Walt Disney, PayPal surpass Bank of America. And I think that's just a reflection of the acceleration of these trends. But coming back to that valuation point that you mentioned, we do need to be very careful with that. Is Zoom worth $70 billion just because it has 300 million daily participants and we're all using it? I think that you need to be pretty confident that they have very sustainable barriers to entry. Now, we would sort of think that actually there are quite a few guys who can do sort of online video tools or sort of work sharing tools. You think about Tesla being worth 50% more than Toyota when they sell 400,000 cars rather than 11 million cars. You're obviously discounting a lot of future growth and a lot of future profits for that company. And I think that's where we need to be careful. I think in some cases, the acceleration of these trends are justified in the share prices. I think in other cases, they've probably gone beyond some of the fundamentals.
Thank you, Richard. And what about the impact that this could have in our lives? I mean, do you think that these trends and these habits that we have been acquiring, because we have been nearly all of us in quarantine, right? Do you think that the new normal will be more about consuming Netflix rather than going back to the cinemas? What is your thought about that?
Well, obviously it's early days in that sort of post-lockdown. We are getting some clues from places like China that are a bit further down the road on that, and we are seeing that some areas are certainly permanently impaired. I mean, you think about business travel, maybe some sort of permanent sort of changes that we're going to have to sort of commercial real estate and sort of offices. It's amazing how quickly things change. I was sitting down with Adam Newman, the founder of WeWork, not too long ago, probably 9 months ago now, and he was telling me the future of commercial office space was kind of WeWork. I think we've just bypassed that and gone to sort of a remote working, which is going to be sort of, I think, a permanent feature of our lives. So we will go back to the office, but I think a lot more people will sort of permanently do some sort of hybrid remote working. I think we will go back to schools and universities, but there'll be a permanent element of people who do remote learning. The same with trade shows and events and business travel and conferences. Yes, some people will go, but many people will also stay at home and access that virtually. So, I do think the world has changed, and behaviors are going to be permanent to some degree going forward. And, luckily technology is on the right side of a lot of those sort of permanent shifts.
We cannot talk about COVID-19 without jumping into health, Lydia, right? I know this has made an impact in a huge number of fields, but COVID-19 is talking about health in first place. So I would like to know your real and honest expectation when it comes to a vaccine for COVID-19.
Well, so far it looks really good in a sense that we have seen the first data on several vaccine candidates actually, and they all show that you can make neutralizing antibodies, and that's the kind of antibodies you need. They kind of cover the virus surface and prevent it from infecting your cells. So that should warrant some kind of protection. The other part of the puzzle is not the same in all vaccines, but some of them have had kind of a T-cell response. So you need a T-cell response to basically have a long-lasting immunity. And for some, they actually have that. So it looks good that actually a vaccine could protect us for longer than just a couple of months. So far so good. What we don't have really is the actual data on protection. So we just know we have antibodies, but do they actually protect? We don't have the answer to that. There are some rare stories of people getting reinfected, but it's not something that we hear common. So we assume that having had the virus or having gotten a vaccine should probably protect you from an infection, or at least should give you a milder disease course. But we will only know that once they run the actual clinical trials that look at the infection rate of vaccinated people versus non-vaccinated people. And we are now starting these trials. So they're ongoing. We'll know more by the end of the year, probably, on the protection. We will, however, get a first glimpse on the efficacy of antibodies before that, because there are some trials ongoing that make synthetic antibodies. So basically, they look at antibodies that people have gotten in response to COVID-19 and make those in the lab and see whether they can actually help make the disease less severe in people who already are infected, so as a therapeutic, but also some prophylactic studies. So you would give this antibody cocktail to a healthcare worker and see whether that lowers the risk of infection. So we'll see those data probably earlier than the vaccine data. But we're optimistic that there will be a vaccine. The only thing that we need to be mindful of really is the whole logistics of vaccinating the whole world, because obviously you need billions of doses, and actually it looks very much like you will always need 2 doses. So far we haven't seen a vaccine that has given enough immunity after 1 dose. So you will need a prime dose and a booster dose a month later to get enough antibodies. So 2 doses for the whole world. You can imagine the manufacturing logistical issues that come with that. And even very random things, such as having enough syringes, having enough glass vials to put the vaccine in and to distribute that, and to actually distribute that in some fair way, and not just having it in the developing world or not just in the rich countries, but actually all over the world. So a lot of kind of hurdles that we need to jump through until we're there. Another one obviously is vaccine hesitancy. If you look at surveys, roughly 50% of the population, depending on where you look, is saying that they wouldn't get the vaccine because they're either scared of it or they don't trust the government. So it's not clear that it's going to be that easy and it's going to be a quick fix. That's probably why I agree with Richard. We will need those Zoom meetings much longer than we'd like to.
Yeah, I fully agree, Lydia. I have the impression that we are kind of obsessed with the discovery phase, which is quite normal, right? Because of the drama that we have gone through. But we cannot disregard that we are a few million people on Earth, right? And distribution and logistics might be a huge issue as well, indeed. A more open question on that, more related to the marketplace. Do you think that the market has already discounted the vaccine and it's priced? That's an open question to you both.
Yeah, so for biotech, definitely. I mean, if you talk about valuation, it's definitely an issue for any stock that is involved with a vaccine. You see, those names are actually heavily retail traded. They do trade very aggressively on news, and it's not really rational in a sense. If you look at the whole vaccine market, it's roughly 30 billion, and you would have to think about multiple times that market size for these valuations to make sense. So I think people have gotten a bit ahead of themselves in those vaccine plays, for sure.
Thank you, Lydia.
Maybe to take it more sort of broadly. I mean, I'm slightly uncomfortable with the idea that, you know, there's a kind of a panacea of kind of a vaccine will kind of make everyone safe and make everyone comfortable to go out and live their lives as they did before. You know, I think, you know, just in terms of timeline and just the fact that, you know, we can't all sit at home for another year or two until, you know, we can get mass produced for billions of people to have a vaccine. I think we're just going to kind of have to do what we've been doing, which is kind of, there will be sort of minor second waves. Hopefully they don't become sort of, you know, global and we have to kind of have national lockdowns again, but it's going to be a bit sort of whack-a-mole. And so you'll get flare-ups in certain parts and we'll have to lock them down again, but we're just going to kind of have to get on with it. And that will continue to have a sort of an impact on the economy. And we're just going to need all that sort of fiscal and monetary support to kind of get us through. It's going to be tough sledging, I think, you know, and sort of we wait until the vaccine, but you know, I just think it's going to be tough sledging for the next couple of years.
Let's keep on talking about health. Sorry, Lydia, you wanted to add something?
Yeah, I was just going to say, I mean, the one positive note that I would add to this is that we're getting better at treating it. So, I mean, we're reducing mortality of the disease, we're reducing the severity of the disease. Let's see how these antibodies do. At least probably will suppress a bit the death rate, but I think the onslaught on the healthcare system is going to stay the same. You're still going to have hospitalization and you still need to control the spread just to keep hospitalizations at bay. So yeah, I totally agree.
I aim to keep on talking about health, which is always a matter of common interest, Lydia, and you are a wealth of knowledge on that. So my question to you would be, besides COVID-19, which is at the forefront for obvious reasons like we just discussed, which other areas do you think that are critical when it comes to new drugs, remedies, and innovation?
Yeah, I mean, the most innovation we have seen in the last couple of years was really in cancer and in rare disease. If you think about the orphan or the rare disease market, roughly 5% so far of all rare diseases have an approved therapy. So there is a lot of need for therapies for people with genetic diseases and with these rare disorders. And they're actually pretty good indications for biotechs to work on because you need smaller trials, you don't need as much capital. And also we've had some technological breakthroughs in the last 2 or 3 years, I would say, with, for example, gene therapies, where we can really take a genetic disease where a gene is missing or a gene is broken, and we can supply that gene back into the patient. And this has opened up a whole new spread of innovation. You see so many IPOs in this field, companies doing really new genetic therapies for that aspect. The other one is cancer. We've seen some innovation. We've seen one big step was when we had this immune oncology, so basically having the immune system fight cancer. So what a cancer cell does is it suppresses the immune system and hides from it, and when you basically suppress the suppression and you get it back activated, you can really target the cancer. And that's been quite promising. And I think one next step here is really personalized medicine, going after the mutations in the cancer cells, sequencing this cancer and knowing which mutation is driving it. And here we see a lot of new companies that have very molecularly targeted drugs that are very specific for these mutations and have been showing really good results. So those are the two main areas, I would say. There's one area that is close to my heart because it doesn't get a lot of innovation and it's actually quite severe, which is antibiotic resistance. I mean, we have a slow moving pandemic actually of antibiotic resistant bugs in around the world. And this is really becoming an issue. And if we don't invest in novel antibiotics and we don't bring new medicines in that field forward, we could live in a world that is post-antibiotic. We could live in a world where infections again kill people, and that's very, very scary. So you see some progress there as well. There has been a consortium of several big pharma companies that have founded a venture together that is pushing into that direction. The reason why this is so underfunded is because you don't make a lot of money on antibiotics, because when you have a new one, people don't want to use it because you don't want to create new resistance. So all these drug companies who have made antibiotics actually went bankrupt. So there needs to be a change in how we pay for that. And I think there is some thinking going on in this field, but that's one that I would love to see more innovation in.
Mm-hmm. I'm sure a few things of what you said are music to the ears of people in the audience, right? Very interesting. And let's get back to technology and disruption for a question, Richard, to change the subject a little bit. This is also common interest, I think. Do you happen to think that there is a single sector which is safe and protected from going through a technological disruption? Because financial companies and banks, we tend to think that they might be a little bit the case due to the high regulation we need to comply with. But what we are seeing in China might be a proxy on a different direction, right? What is happening with Alibaba and Tencent could be an indicator of what we could be envisaging in other sides of the world soon.
Yeah, it's a fascinating question, isn't it? Now, I'm a technology manager. Obviously, I'm biased, but I don't think technology is going to take over everything. I'm not that evangelical, and I was reminded of that the other day because my 5-year-old lost his first tooth this week, and I don't know if you have this tradition in Brazil, but the tooth fairy brings some money for your first tooth. And I don't know about you, but my wallet, I haven't used it in months. It's gathering dust on my fireplace, and we just didn't have any cash in the house. And a 5-year-old's faith the next morning when I told him that the tooth fairy had promised him a digital payment of cash, was pretty underwhelming. So I think certainly some professions are safe, including the tooth fairy. Now, on a more sort of serious note, I do think that there are some important trends here that are very important to think about when we answer this question. One is demographics, and I think that's because younger people have grown up in a smartphone internet world, and they're just used to lower friction of using and consuming goods and services. They don't go to shops; they just want a one-click buy on an Amazon app. They don't go and buy CDs anymore. They just listen to it on Spotify or on Apple Music. They don't go and rent videos anymore. They don't even learn to drive anymore. They just use Uber, and they're used to just clicking and getting some food delivered from a restaurant. Now they are just going to have the way they're going to consume things like financial services in the future. Their expectation of what that service would be to them. They don't want to go and stand in line in a bank. They want to sign up on an app and have everything sort of brought to them. And I think as those younger people come through, and increasingly that generation is now sort of the majority of the workforce, and increasingly over time will be the majority of kind of spending power, companies have to react to that. If they don't react to that, they're going to be disrupted by technology companies who will provide that service. That sort of Jeff Bezos mantra of your margin is my opportunity. Now, the power of technology, and you mentioned Alibaba and Tencent, is it democratizes services, and it democratizes things like financial services. Alibaba, and specifically sort of Ant Financial, which does the fintech side, It's providing financial services, things not just payments, but lending, wealth management, insurance, to hundreds of millions of Chinese people who've just never been provided that service by a bank because it just wasn't economically viable. And you're seeing similar trends in India, in Latin America, and starting to see some of that in Africa too. Now, that's why I think you see the biggest amount of disruption. So I don't think what you've seen in China is applicable to Europe or the United States, where not only is there regulation that supports these banks, but also there's just a lot more incumbency. We all have a mobile banking app. We all have multiple credit cards. But in sort of areas where people haven't signed up to a bank to get a bank account or financial services, their first port of call is probably going to be a smartphone app. It's not going to be walking into a bank. And I think that changes the franchise values when we think about stocks. That changes the competitive moat and really undermines a lot of competitive moats. I mean, a bank used to be very powerful because, especially in emerging markets, you open a new branch in a new city, in a new town, and you densify, and that's the way you attracted customers. These days, that's just not the way you do it. You can just do it through a smartphone app, through platforms like WeChat or Taobao. And it's just, they're going to get to these people before a bank's ever been able to get in front of them. And, you can extend that to other industries, like an auto industry. Your franchise used to be spending billions developing an internal combustion engine, spending billions to create a factory to make that, drivetrain and all the incredibly complicated engineered parts that went into that. An electric car's only got, 30 or 40 moving parts. You buy the battery from a Korean maker, you're not really doing a lot. And so your competitive moat, is completely gone away. And it's probably more about being able to sort of upgrade software over the air like Tesla's doing and now Mercedes is going to do, or moving into sort of autonomous driving. You're going to have to be able to design apps rather than internal combustion engines. And we're seeing that time and time again in new industries that, actually increasingly, those competitive moats that people sort of relied on for 40, 50, 100 years are now ending. And then you sort of put on top of that as well, I think, if we think about this crisis and how it's impacted so many sectors, how many companies have had to go for state bailouts. If they haven't had state bailouts, they've had to cut not just the dividend, but things like R&D. They've had to get rid of people, unfortunately. They're coming out of this crisis weaker. In contrast, many of the technology companies are coming out of this crisis stronger and have had very strong balance sheets in advance of this as well. So they're in a much better place to kind of win that battle, to disrupt those incumbents coming out of this crisis. So I think between the two of them, you're going to see an awful lot of disruption over the next decade. Not everything, but I think there's some major markets that are going to be disrupted in the next 10 years.
Absolutely. If I may drop an example, I feel very identified with this disruption within the financial sector. I've been working in the financial sector for a while now, and the company I work, Allfunds, that used to be more a clearing, settlement, and added value platform of international funds, has made such a swift towards a digital wealth tech value proposition. So we are the perfect example of this technological disruption within the financial sector ourselves, and very, very happy to hear your thoughts on that, Richard. It was very interesting. I think we have many people in the audience managing assets and money. So let's get back to the stock market for a second, and let's keep on talking about technological companies. Because Richard, we have seen a very decent outperformance of the S&P versus the rest of the world, right? Over the last 5 years, quite particularly due to the large technological companies. Do you think that this trend will remain in place?
Well, I think I can get away with saying this because we're in a global trends webinar, but I just don't understand asset allocation by geography. This idea that you allocate to a US fund or to an emerging market fund or a European fund, I just think is so outdated. I think the reason why certain markets have outperformed is purely down to their exposures in that market. Now, I come from the UK, very similar to Latin America, 1% exposure to technology. And you look at the S&P 500, 28% exposure to technology. I think everyone knows what the relative performances of those markets have been. Outperformance of 70%, 100% in the last 5 years alone. And I think it's for all the reasons we've talked about so far. So if you're sitting in Brazil, you're sitting in the UK here with me, you are structurally underweight technology as a domestic investor. Whether you want to be or not, your starting point is you're 25% underweight tech. Now you've got to really do something to rectify that. And there's some fairly obvious ways you could do that. But if you certainly believe that these technology trends are here to stay, if you think you're going to spend more on technology in your lifetime, if you think your children are going to spend more on technology in your lifetime, then the earnings growth of the tech sector is going to be higher, and you really want to get some exposure to some of that. So I think these trends are very long term. They are sustainable. You have to obviously watch the valuations. You have to make sure you're on the right side of some of these technology trends. Even within technology, some of these companies get usurped or get disrupted. But these trends are here to stay, and you've got to think about it from a global thematic point of view, and I'm sure Lydia would sort of agree with me on this, rather than thinking about geographic allocations.
Talking about trends, Richard, that might stay in place, what do you think about the context out of which tech giants are constantly buying newcomers? A very illustrative example could be Facebook and Instagram. Do you think that this trend could be reverted at some point?
Yes, I do, because that example is a great example, and it was also over a decade ago. Now, I think the world has changed in terms of regulation and antitrust. You've already got some very large sort of antitrust investigations going on into big tech in the US, and I just think the days of those big companies being able to just buy the newcomer. You think about Google buying YouTube, even Google buying Fitbit is getting an awful lot of antitrust and regulator scrutiny at the moment, and who cares about Fitbit? So I just think those days are gone, and I think that's why you're seeing the buildup of cash on the balance sheets of these big tech companies. They don't want to have $100 billion there. It's just they can't really go and buy anything because of that regulatory oversight. The sort of anomaly to that is in China. You look at a company like Tencent, they've got over 700 investee companies. They've got a sort of private and public investment book of about $100 billion, pretty much the same size as the SoftBank Vision Fund. And they've been able to very much not have that regulatory oversight, be able to go and do that. And they have their tentacles pretty much in everything in Chinese internet, fintech, health, as well as increasingly kind of on a global scale too. Their US counterparts just not being able to do that, and European sort of regulatory oversight is even tougher. So I do think the world has changed, and that creates opportunities for newer companies to flourish more outside of those kind of the shadow of those big tech companies in a way that's very difficult to do in China.
Lydia, talking about the market, would you be so kind to share with us your view when it comes to flows and valuations within both health and biotech, please?
Yeah, sure. I mean, this has been year to date. It's been very strong for both themes. We've seen record inflows in biotech, and actually the biotech sector. It's been the biggest quarterly inflow into the sector since I think ever. So at least since 2008 for sure. I think it was like 7 billion inflows into biotech, which is insane. And also just that the deal pipeline, so the IPOs, the new companies coming to market, has been very, very active. So there is a lot of interest. I think structurally people still are underweight generally biotech. So I think it's not stopped the demand so far. And different than tech, we actually didn't have these outperforming years the last couple of years, because in 2015, you probably may remember that Hillary Clinton in the presidential or the run-up to the presidential campaign started tweeting about drug prices, and that was in everybody's minds. People got a bit freaked out about drugs, and there was quite a underperformance of biotech and healthcare the last couple of years. And we had some catch-up growth this year, but it's not caught up everything. So I think there's still upside in terms of the valuations, more in the small and mid-cap space. So we have to be a bit more selective. In the large caps, pretty much a lot is priced in right now. But if you're a selective investor, obviously you find your attractive bets. One thing, though, that I will flag to investors interested in this space is that we are in an election year, and that is always very important for healthcare and biotech, and not so much for healthy living, obviously. But the healthcare sector is very heavily weighted towards the US because there is a discrepancy on the pricing side from the US versus the rest of the market. So if we have a Biden presidency, if we have a Democratic Congress with both houses flipping to the Democratic side, you will very likely have a healthcare reform. I think that the COVID-19 crisis has exposed so many issues with the healthcare system in the US that there will be some changes. So that will introduce some uncertainty, which the market usually doesn't like. We don't think it's going to be a huge setback for drug pricing in general. I think the model of pricing will probably change, and is already changing, away from just putting a random price on your drug and pricing it as high as you can, towards a more value-based pricing system. So you actually make a pharmacoeconomic calculation. How much am I saving the society by treating this patient, by giving this patient a full work life, by giving this patient a good quality of life, and what's a price that is reasonable, that it's net still a saving to society, and we're moving into that direction. But there could be some uncertainty coming from that in the coming years.
Just for you to know, I was taking a look at the biotech flows on our database. I think it was last week, and I had that impression that the inflows were amazingly remarkable, right? Another thing that comes to my mind is that I have the impression, and correct me if I'm wrong, Lydia, when talking to investors a while ago, health used to be like a very broad thing, like big pharmas, and that was pretty much it. And now people are talking about very impressive things, right? Investors are talking about genetics, longevity, big data applied to surgery. The level of granularity is amazing, right?
Yeah, there's a lot of innovation going on. Obviously, it's also coupled to tech in a lot of ways, especially in the whole healthcare system where you deliver these services. I mean, just look at the health insurance company. I mean, they are in the perfect spot to do AI, just because they get all these data from claims, so they know which patient is consuming what and has what outcome. And just that data set alone makes them the biggest digital health companies. So there is a lot of innovation going on. A lot of it is still in the private side, especially on the digital health side. So it's not investable just yet, but I think the pipeline is full just to have a really deep innovation coming from that. And the system is ripe also to be disrupted, to have better electronic health records, better ways to match data between systems, to have a data system that is basically readable from different providers, and not just this hospital has X, this hospital has Y, and they're not compatible one and another. So there's really a lot of need for disruption, and there is also a pipeline full of disruptive companies.
How interesting is that? We could spend days talking about it, Lydia, frankly.
Sure.
Let's touch base on something that might resonate with many people in the audience, because my belief is that we might have a good number of fund selectors. So Richard, let's talk a little bit about the asset allocation when it comes to tech funds, because to the best of my knowledge, they seem to be overweight in the US versus China. Kind of 90% versus 10% could be a rough indication. So this is quite remarkable in favor of the US. And on the other hand, it seems to be that China is more advanced when it comes to technology adoption. So do you anticipate a change around that?
Yes, it's a fascinating question, and also, there's a lot of things going on in the world geopolitically that sort of feed into that. I started life, looking at Asian tech, and particularly Chinese technology companies. I first visited there in 2004. Was there for the Tencent IPO, and in my entire time, despite all of the growth in technology, all of the sort of growth in China, all that adoption that you talked about, there have basically only been 3 really successful technology companies in China that have sort of lasted the test of time, and that's Huawei, which obviously has some challenges today, Tencent and Alibaba, and a few sort of honorable mentions you could have for a few other internet companies. There have been very few companies that have been able to kind of have that sustainable barriers to entry to be able to be successful for many years. A few guys that kind of shone brightly and then faded. I do think that's going to change for a couple of reasons, going forward. One, I think, is that, when you think about kind of where China is in new technologies like 5G, like AI, they're at the top table globally. I mean, it's them and the US, with Europe, well behind, to be honest. And that means that there are going to be some very interesting companies that come through on that side. And then when you think about kind of what's happening sort of geopolitically between the US and China, I think everyone in China knows they're going to have to build up their own sort of domestic technology sector. Now that's not new to me. I've been, they've done that in the internet already with the sort of the Great Firewall and sort of all these domestic champions in China. There is no FANG in China, and it's Alibaba and Tencent. Those companies we've invested in and made a lot of money in. And I think something similar will happen in many other areas of technology in China, particularly in the semiconductor space. And we can take advantage of that too. So it's not something that we're afraid of. It's going to create a lot of opportunity for us. I think over time we'll have more exposure to China going forward. But again, I'll come back to valuation again. The issues that we have sometimes with the reasons why we end up back in the US is that actually because there's more tech in the US, there's less scarcity premium on the stocks in the US. There are 5 companies that do something in tech in the US, while there's 1 in Europe, there's 1 in Japan, 1 in Latin America. And as a result, all those investors that have to keep money within those geographic boundaries all buy that stock. So ASML is way more expensive than Applied Materials or Lam. Mercado Libre is much more expensive than Alibaba. And I think as global investors, we can try and sort of arbitrage that to some degree and pick the best risk reward, the best valuation globally, rather than being sort of caught in one area where there's only one stock to buy.
Right. There are remarkable facts which I was talking about that. And when you take a look at size and key numbers and facts, there are something which are quite remarkable, such as the size of the internet population in China or the online retail scene in China. So do you think that that will end up making an impact, and why it doesn't have made such an impact as of today? Do you think that the transparency is playing a critical role on that, or?
I think it's a combination of 2 things. I think it's very much dominated by Alibaba and Tencent. As I said, they've really sort of come through and really dominated basically everything. I mean, it used to be BAT, it used to be Baidu, but Baidu's really sort of fallen by the wayside and almost been replaced by another B, which is ByteDance, which owns TikTok. And those companies, as I said, have been able to invest in so many companies in every sort of area and sort of facet of China. So if you want to do e-commerce, yes, there's Alibaba, but Ant Financial dominates fintech, and they dominate cloud. They're trying to do Ali Health. So everywhere you look, it's basically an opportunity being taken by either Alibaba or Tencent directly, or via one of their affiliates or someone they invest in. Which means that there haven't been too many companies that have been able to kind of grow sort of outside of the sort of the remit of those companies, which has sort of limited the opportunities for other companies. And you see that in Southeast Asia too, as well. So we very much have focused on those 2 companies as a result, and found it very hard to actually find too many other opportunities outside of that.
Good. And luckily, I think we don't have much time left, despite the interesting topics we are going through. And I would like to end up this debate with a common question for you both. It was not easy for me to make common questions because you are both master of knowledges, but within different fields. But I think this will resonate with you both. And it will be about a matter of common interest, which is the US elections. And November 3rd is fast approaching. So I would like to know the potential impact that the US elections results might bring to technology, biotech, health, when it comes to taxes, regulation, innovation, and so on. So,
ladies first, I guess.
Yeah, ladies first.
Yeah, so I mean, the way it looks right now, Biden is obviously leading very strong. We shouldn't call it right now because I mean, a lot of things can happen. But to us, a Democratic president alone is not saying much. What you need is the majority in Congress as well to get things done. The way it looks now, that is a possibility, and there could be some healthcare reform. When you look at Biden and his history, obviously he's been the VP under Obama, and he is very much probably one that is going to extend on what Obama already started. So extending the Affordable Care Act or Obamacare, which is a lot about access to medicine. So it's making sure that more people are insured, have affordable health insurance to be covered. Because the way the system is set up right now, it is that a lot of people have very, very high copays. So they pay a lot out of pocket, which prices a lot of people actually out of seeking care. And it is creating much worse health outcomes. I mean, the US healthcare system is the most expensive in the world, but in terms of the outcomes, they're actually trailing with like the 20th or so company, if not worse. So it's they pay a lot, but they don't get a lot for it. And I think that's probably going to change with more people getting access. So you're shifting part of the economic burden from the patient to society, to the insurance, but also to the drug makers. So you will probably have some concession on price in some instances. But you will have an offsetting thing that is the volume. So you will get more people consuming care, and that probably will offset it to a certain extent. And I think it is a quite necessary reform, and it will probably happen. It's not going to happen the way that people like to, or I think it's not going to happen the way people like to talk about it, which is just drug prices and limiting drug prices. It's much more complex than that. There is a very intricate system of different institutions that take part of the cake, and it's very low transparency who takes what. And I think shining a light on that will also help. So it's a complicated situation, but I think the end result will be more people having access to affordable healthcare, which will not be a neutral to positive for the healthcare industry.
Thank you.
I think on the technology side, there's probably limited differences, between whoever ends up in the White House. I think there were some broader outcomes and maybe some more radical outcomes when we had some more extreme Democratic candidates that were looking like they might sort of get the nomination. I think Biden is going to look to raise taxes to some degree, and that will impact some of the corporate profits of those US companies, and they may look to close some of the loopholes that some of big tech were using to kind of have profits overseas. But outside of that, I think a lot of things are going to happen whoever's in the White House. We are going to have that US-China sort of global supremacy kind of Cold War, if you will, is not going to go away. I think we're going to get more regulation and sort of antitrust investigations into US big tech either way. So I think in many ways, we're not going to see too much difference between whoever's in there, unless of course sort of Kanye gets in which case I think the social media companies will be very happy.
Lydia, Richard, thank you very much for your unique contributions to this debate. It was really a great honor to be here with you both, and I hope we can have another discussion at some point in the future. Meanwhile, I wish you the best of luck with your relevant strategies, bringing a lot of alpha and added value to the Brazilian market. Muito obrigada.
Thank you.
Thank you, Laura.
Thank you, Laura, Lydia, and Richard for joining us today. Obrigada a todos que participaram da nossa live. Hoje a gente finaliza a nossa semana de Global Managers Conference. Espero que ano que vem a gente possa fazer essa conferência presencialmente. Para quem quiser entender sobre investimento no exterior, conhecer um pouco mais sobre as gestoras, nosso e-mail está aqui embaixo. Fiquem à vontade para nos contatar. Obrigada, gente. Até a próxima.